There is a lesser known 401k strategy that can turn a huge chunk of your 401k money from being taxed at ordinary income rates into be taxed at long-term capital gain rates, potentially saving you tens of thousands in taxes. If you own company stock in your 401k or other employer-sponsored plan, this strategy represents a huge opportunity to your retirement. The strategy is called Net Unrealized Appreciation, or NUA for short. Let's say you're someone who has worked for your company for years and has built up a sizable company stock position within your 401k. Now, normally any money you withdraw from that 401k, including company stock, gets taxed at ordinary income rates. In addition, this account will eventually be subject to RMDs, where you're going to be forced to draw down your 401k or IRA rollover, whether you want to or not. Net unrealized appreciation changes all of this. Let's take a company stock situation where this sample retiree has $50,000 of cost basis in the underlying stock and $600,000 of growth. Again, when kept in a 401k, this cost basis versus growth amount doesn't matter. But through NUA, you have the opportunity to do something pretty interesting. You are able to in-kind transfer that company stock out of your 401k and into your taxable account. When you do that, you'll pay ordinary income tax only on the original cost basis of the stock. The rest, the growth, is taxed later at long-term capital gain rates when you eventually sell shares. So in this case, initiating this strategy would lead to $50,000 of ordinary income. But then the additional $600,000 of growth is considered unrealized gain, as if you normally grew this position within your taxable account. This can be a massive advantage for a few different reasons. First, capital gain rates are always less than ordinary income rates at every step of income. If you had ordinary income in the 10% or 12% brackets, capital gains at the same level would be tax-free. If you have income in the 22% bracket, capital gains would be taxed at only 15%, and so on. Second, taxable accounts are not subject to RMDs, so you're never going to be forced to sell that company stock. Then finally, if you were to hold on to that company stock until the end of your life, your heirs will receive a step up in basis, eliminating all of the tax obligations of that position. Now, there are some important details you need to be aware of if this is a potential opportunity in your retirement plan. First, you have to qualify based on one of these three qualifying events. You've reached age 59 and a half, you've separated from work, or become disabled or passed away. So if you're 61 and still work for your company, you are eligible for an NUA, assuming other conditions are met. If you are 50 and change jobs, you are also eligible for this strategy. Once you start the NUA process, you need to empty the rest of your 401k by the end of that same year, usually by rolling the rest into an IRA. Also, the stock must be transferred in kind. You can't sell it first and move the cash. That would basically trigger full ordinary income tax on that company stock, or the cash amount rather. The good news is though, NUA doesn't have to be an all or nothing thing. You can choose to move only a portion of that company stock, say $100,000 instead of that full $650,000. And this only works with employer-sponsored plans like 401ks, ESOPs, profit-sharing plans, not IRAs. Now, even if you qualify to use NUA, there may be some mistakes you might make in the interim that could eliminate your potential eligibility. If you roll your company stock into an IRA, even for a second, you will kill your NUA opportunity. NUAs are not allowed from an IRA. If you take any money out of your 401k after your triggering event and before the transaction, NUA is disqualified. No do-overs. Your lump sum distribution has to happen in the same year as your triggering event or later, but only if that account has not been touched. Get the timing wrong and you lose NUA. I have a visual down below with an example. The NUA can be initiated years after a qualifying event, but only if no withdrawals have been made from that 401k. Now, with the example I've given this far, net unrealized appreciation might seem like a no-brainer. However, I do want to cover a few scenarios in which it probably wouldn't make sense for your situation. The most common is a scenario where your company stock just really hasn't appreciated that much. When company stock is highly appreciated, like in our example so far of $50,000 of cost basis, the opportunity here is significant. You pay a relatively small upfront cost to turn ordinary income taxes into capital gain taxes. But let's say cost basis was $500,000 with only $150,000 of appreciation. In this scenario, you're paying way too much upfront in taxes to get a much smaller benefit on the back end. Remember, the transaction happens all in 1 year, so $500,000 worth of ordinary income will cause your tax bill to skyrocket. Next, one thing many investors will forget is that a taxable account during growth isn't as tax efficient as a 401k or IRA would be. So it's really important to have a plan for what you're going to do with the stock once inside of your brokerage account. If you're going to hold on to that stock indefinitely, you need to factor in the cost of something called dividend tax drag. Here's how dividend tax drag works. Say you have $800,000 worth of company stock, and that stock releases a 3.5% dividend. Inside of your 401k or IRA, this dividend has no effect on your annual tax liability. However, inside of a taxable account, that dividend might be costly. Following the example on the screen, if that $28,000 of dividends is taxed at 15%, you will owe an extra $4,200 of taxes in this given year. This means at the end of the year, you will have less money in your taxable account versus what you would have had in your IRA. Compound this effect every year, and it will lead to a long-term difference between these two accounts in a 3 to 10% range, which could be larger than the tax benefit of doing the NUA in the first place. So it's important to note there will be a slight growth cost within that taxable account depending on dividend rates. This doesn't necessarily rule out the NUA, but just needs to be considered. Then finally, if the company stock you own is too large of a share of your asset situation, an NUA might complicate your situation further. For instance, let's take a situation where this investor has $2 million in retirement assets. $650,000 of company stock means they have over 30% of their portfolio allocated to one single stock. This is extremely risky and something this client should diversify away from regardless of the company they own. In a 401k or IRA, there is no cost to adjust asset allocations and diversify away from that company stock. In a taxable account, there could be potentially a great cost. If we wanted to cut this allocation in half, we may have $300,000 of capital gains we may have to pay taxes on. That's a big tax hit up front. And not only that, creates a psychological barrier that leads many investors to avoid trimming that concentrated position. Ultimately, the risks of that concentrated position can ruin any tax benefit of doing the NUA in the first place. Now again, wanting to move away from a concentrated stock position alone does not rule out an NUA, but certainly does create another complicated barrier that we need to factor into the analysis. The general structure of an NUA transaction is quite simple, but the analysis on the back end isn't. Then I have one final strategy adjustment that you can use to make sure you maximize your NUA transaction. Remember that you can do partial transfers of company stock. It doesn't have to be all or nothing. Given this, you can actually cherry pick the lots that have appreciated the most to ensure that you are gaining the most benefit from the initial transaction. Likewise, you can avoid lots that have a high cost basis right now and would cost too much to move to your brokerage account. Now, NUA can be a brilliant tax move for some and an unwise move for others. I'd recommend working with someone with experience in this transaction to best work out if it makes sense for your situation. In addition to this 401k strategy, there's a common problem that every retiree will face when they roll over a 401k into an IRA. Luckily, I've got a video right here that talks about 5 ways you can avoid this costly problem. Click here to learn more, and always remember, you don't need more money, you need a better plan. Look forward to seeing you in the next video.